Continuation of Chapter 3. Methodology. At the risk of gross oversimplification, it can be said that the advantages of tax havens are reviewed in the following four principal contexts. A. Personal residency. Since the early 20th century, wealthy individuals from high-tax jurisdictions have sought to relocate themselves in low-tax jurisdictions. In most countries in the world, residence is the primary basis of taxation. Almost no tax haven assesses any kind of capital gain tax or inheritance tax. Individuals who are unable to return to a high tax country in which they used to reside for more than a few days a year are sometimes referred to as tax exiles. B. Corporate residency. Corporate persons, in contrast to natural persons, can own subsidiary corporations in many countries. That allows them to take advantage of the variety of laws, regulations, and conventions in multiple countries without overly engaging in questionable activities. Only in extreme cases will they move their formal corporate headquarters. C. Asset holding. Asset holding involves utilizing an offshore trust or offshore company, or a trust owning a company. The company or trust will be formed in one tax haven and will usually be administered and resident in another. The function is to hold assets, which may consist of a portfolio of investments under management, trading companies or groups, physical assets such as real estate or valuable chattels. The essence of such arrangement is that by changing the ownership of the asset into an entity which is not tax resident in the high tax jurisdiction, they cease to be taxable in that jurisdiction. Regulation measures. To avoid tax competition, many high tax jurisdictions have enacted legislation to counter the tax sheltering potential of tax havens. Generally, some legislation tend to operate in one of five ways. 1. Attributing the income and gains of the company or trust in the tax haven to a taxpayer in the high tax jurisdiction or on a rising basis. Controlled foreign corporation legislation is an example of this. 2. Transfer pricing rules, standardization of which has been greatly helped by the promulgation of OECD guidelines. 3. Restrictions on deductibility or imposition of a withholding tax when payments are made to offshore recipients. 4. Taxation of receipts from the entity in the tax haven, sometimes enhanced by notional interest to reflect the element of deferred payments. The EU withholding tax is probably the best example of this. 5. Exit charges or taxing of unrealized capital gains when an individual, trust, or companies emigrates. However, many jurisdictions employ blunter rules. For example, in France, securities regulations are such that it is not possible to have a public bond issue through a company incorporated in a tax haven. Also, becoming increasingly popular is forced disclosure of tax mitigation schemes. Broadly, this involves the revenue authorities compelling tax authorities to reveal details of the scheme so that the loopholes can be closed during the following tax year, usually by one of the 5 methods indicated above. Although not specifically aimed at tax havens, given that so many tax mitigation schemes involve the use of offshore structures, the effect is much the same. Anti-avoidance came to prominence in 2010-2011 as non-governmental organizations and politicians in the leading economies looked for ways of reducing tax avoidance, which plays a role in forcing unpopular cuts of social and military programs. The International Financial Center Forum (IFC Forum) has asked for a balanced debate on the issue of tax avoidance and an understanding of the role that the tax neutrality of small international financial centers play in the global economy. Criticism. Tax havens have been criticized because they often result in the accumulation of idle cash, which is expensive and ineffective for companies to repatriate. The tax shelter benefit results in a tax incidence disadvantaging the poor. Many tax havens are thought to have connection to fraud, money laundering, and terrorism. While investigation of illegal tax haven abuse have been ongoing, there have been few convictions. Lobbying pertaining to tax havens and associated transfer pricing has also been criticized. Some politicians have begun to stand up against the use of tax havens by large companies. She described the act of avoiding tax as a threat to democracy. Accountants' opinion on the propriety of tax haven have been evolving, as have the opinion of their corporate users, governments, and politicians. Although they are used by Fortune 500 companies and other remains widespread. Reform proposals centering on the Big Four accountancy firm have been advanced. Some governments appear to be using computer spyware to scrutinize some corporations' finances. Subtopic: Executive on Foreign Assignment. Executives on foreign assignment. Income tax is levied on individuals who perform employment duties in Nigeria and those resident abroad, but who are employees of the Nigeria government. An individual who is an employee of a non-resident entity is not liable to tax in Nigeria if he or she spends less than 183 days, that is 6 months, in Nigeria in any 12-month period, and if his or her remuneration is subject to tax in the country of residence. Where foreign nationals are on assignment in Nigeria and will last for less than 183 days, taxes may not be applicable. However, the nature of the visa obtained may inadequately put the individual in a taxable position. Most countries of the world depend on their residency rule for tax liability to attach. Therefore, Nigeria executives on short-term assignment are not likely to be subjected to foreign tax laws except for taxes like VAT and withholding tax. Subtopic: Foreign direct investments. A. Foreign direct investments are not inflows of investments to acquire a testing management interest, that is 10% or more in an enterprise operating in an economy other than that of the investor. It is the sum of equity capital and short-term capital as shown in the balance of payments. This series shows total net, that is net FDI, in the reporting economy to the rest of the world. B. There have been, however, some incentives that have been provided by the federal government to invest in Nigeria. C. In December 1989, Nigeria Enterprise Act permitted 100% foreign ownership in any new venture except those in banking, oil, insurance, and mining. D. In 1992, the Nigeria Free Zone Act was passed, establishing Nigeria Exporting Processing Zone Authority, Free Trade Zone. E. Transferability of funds. Nigeria Enterprises Promotion Act provided that a foreign investor in an enterprise shall be guaranteed unconditional transferability of funds through an authorized dealer in freely convertible currency of dividend of profit. Subtopic: Non-tax factors. Once an investor has determined that the business structure of his or her investments, the investor engages in identifying a jurisdiction with the infrastructure that will optimally attain his or her objectives. Infrastructure presents tax and non-tax of the particular jurisdiction. The tax regime that applies in a specific location is generally an important of a holding company and usually plays a role as far as decision company should be established is concerned. However, tax factors cannot be undermined as they are key to the success of the investment that is undertaken. Factors that affect the choice of location. In other words, locational determinants will differ from one business to another, depending on the objectives of the investment. The more important non-tax factors include A. Economic and political stability. B. Adequate physical, business, accounting, and legal infrastructure. C. The absence or limited presence of bureaucratic obstacles. D. Adequate communication channels. E. Ability to negotiate profits freely. F. Effective banking system. G. The availability of an adequate dispute resolution mechanism. The social, economic, and political stability and risk within different countries are major considerations in the decision making, especially where the need for the raising of finance is important. A factor that supplements the social, economic, and political stability is the functionality of the country's legal system and rule of law. Thus, not only should the legal system be suitable for transacting, but it should also be possible for legal subjects to enforce their legal rights, Alternative dispute resolution as a legal process is normally an expedient and cheap alternative to the often lengthy legal processes. Where available, it too should be reliable. The country's governments should also respect the rule of law and ideally have an enshrined constitution that protects the rights of the country's subjects, as Olivier and Honeybal observe. A combination of operational business activities with an intermediary holding company in a single legal structure could expose an operational company's assets and investment to commercial risk. Stable laws and ease of compliance could assist in offsetting such risk. The commercial language of the host country is also important. It is important that the language used is the same as the language of the investor, or at least a common language such as English or French. The importance of this factor is illustrated by the loss of popularity of the Danish holding company structure due to the requirement that compliance and reporting documentation had to be in Danish. Linked to the prevailing commercial language are reliable communications channels such as telecommunication, fax, and email, without which the performance of various roles would be impaired. Business deal with control and management, including investment management, and the discharging of such services requires a few highly skilled people in the area of law, financing, and financing structures, economics, accounting, and auditing. Most holding companies do not necessarily require large number of employees to be stationed in the host country. Chapter review. This chapter deals with tax planning, tax avoidance as tax schemes that taxpayers could utilize to achieve tax savings. Such tax saving schemes are only allowed if obtained through legitimate exploitation of loopholes in tax laws. Tax evasion effected through fraud is subject to criminal prosecution and is subject to fines and/or imprisonment. This chapter also discusses communication with clients, relevant tax authorities, and related parties. Current issues about tax registration, self-assessment, e-payment, objections, and tax queries procedures were equally discussed. Worked examples. Question 1. A taxpayer has been running his business under the name Chisco Enterprise for several years, a limited liability company, that is Outsourcing Enterprise Limited, in the same trade, was desirous of expanding its own market share. It therefore decided to make an attractive offer to the proprietor of Melami Enterprise. The proprietor is keen to accept the offer because of its attractiveness. The sale is scheduled to take place at a mutually agreed date. The following details relating to Melami Enterprise are made available. Adjusted profit for year ended 30 September 2001, 80,000. Adjusted profit for year ended 30 September 2002, 240,000. Adjusted profit for year ended 30 September 2003, 360,000. The estimated profit for the year to 30 September 2004 and that for the period to 30 January 2005 have been given as follows. Year ended 30 September 2004, 430,000. 3 months to 31 December 2004, 60,000. 1 month to 31 January 2005, 10,000. Required. Advise the proprietor of Melami Enterprise on whether to dispose the business on 31 December 2004 or on 31 January 2005. Support your answer with relevant computations. Suggested solution to question 1. May 19th, 2006. The proprietor, Melami Enterprise, Jibowu, Lagos. Dear sir, read. Advice on appropriate date of cessation. The above subject refers. We wish to advise that on cessation of business, the tax authority has the right to assess the business either on actual year basis or on preceding year basis for the penultimate year. In practice, the tax authority will choose the higher of the two. For the final year, the assessable profit is the profit from 1st of January to the actual date of cessation. From the above, it can be seen that when profit is accruing at a reducing rate towards the date of cessation, it is more tax efficient to delay cessation as long as possible and vice versa. From the computation attached, the profit was reducing towards the date of cessation. We therefore advise that the cessation be delayed till 31 January 2005. Thank you and best regards. Yours faithfully, PAL Associates Limited. Fash Oni, Managing Consultant. Workings. A. Computations assuming 31 December 2004 as date of cessation. 2003, the higher of 1. 1st of January 2003 to 31 December 2003. That's 9 months. So we have 9/12 multiplied by 360,000 naira plus 3/12 multiplied by 430,000 naira. So that means we have for a full year, that's January to September and then October to December. So this gives us 377,500. 2. 1st of October to 30th of September 2002 gives us 240,000 naira. For 2004, 1st of January 2004 to 31 of December 2004 gives us 382,500. B. Computation assuming 31 January 2005 as date of cessation. So for 2003 we have 240,000. 2004 we have 382,500 or 360,000. For 2005 we have 10,000. Summary of assessable profit. Tax year 2004 and then 2005. For the tax year of 2003, we have 377,500 for 2004, while we have 240,000 for 2005. For the tax year of 2004, we have 382,500 for 2004 and 382,500 for 2005. For 2005 tax year, for the year 2004 it is new, while for the year 2005 is 10,000. So the total for 2004 is 760,000, while the total for 2005 is 632,500. That's the assessable profit. Question 2. Recently, the federal government, through the finance minister, announced increase in the capital base of all categories of insurance companies. Opinion is, however, divided on the appropriateness or otherwise of this policy directive. You have been appointed as a consultant by Ultimate Risk Limited, a Nigerian insurance company, to guide it through the entire process of raising the necessary additional capital through the Nigerian Stock Exchange. Required: advise the management of Ultimate Risk Limited on the tax implication of the issues listed below. A. The cost of increasing the authorized share capital with Corporate Affairs Commission, Abuja. B. The cost of obtaining approval from regulatory authorities like the Nigerian Stock Exchange, Securities and Exchange Commission, and National Insurance Commission, NICOM. C. Acquisition of another insurance company. Concern yourself only with the tax implication from the side of the acquired company. Solution to question 2. The Board of Directors, Ultimate Risk Limited, Lagos. Gentlemen, re. The tax implication of meeting the new capital base for insurance companies. We wish to thank you for our recent appointment as the consultant in respect of the above subject. We write to advise that A. There is need to increase the authorized share capital from its present level to that stipulated by the recent policy directive. The relevant fees to be paid to the Corporate Affairs Commission, Abuja, are of a capital nature. This therefore serves as a guide in treating the amount as a disallowable expense for tax purposes. This is the position of the tax law. B. The cost of obtaining approval from the relevant authorities like Securities Exchange Commission, SEC, Nigerian Stock Exchange, NSE, and National Insurance Commission are also capital in nature. They will thus be treated as disallowable for tax purposes. C. In the case of an acquisition of another company, it is to be expected that the acquired company will cease to exist. This is the first tax implication for the acquired company. The issues before acquisition of the company are as follows. 1. Find out the tax status of the company to be acquired. Have all returns been filed? Have all taxes been paid? 2. Check outstanding tax queries and determine the tax implication of any of them. 3. Confirm that tax audit has been carried out on the acquired company. 4. Obtain copy of the company's tax clearance certificate. 5. Ascertain all outstanding issues on VAT and resolve same. 6. Ensure that capital gain, tax on any asset disposal are paid to the relevant tax authority. 7. Check withholding tax files for outstanding issues and resolve same. 8. Confirm payment of adequate stamp duties to be sure there will not be any outstanding payments due to misstatement of stamp duties paid during previous increases. 9. Cessation rule will not apply to the acquired company as it is deemed to be continuing in business. 10. No initial allowance will be granted on the asset. 11. The asset will be deemed to have been transferred to the acquiring company at tax written down values and therefore to be written off over the unexpired life of the asset. We hope this report will be carefully considered by the board in due course. Should you require further clarification, please do not hesitate to contact us. Thank you. Yours faithfully, for A to Z Consultant, Peter Okolo, for Managing Director. Note: this is a question on the process, cost, and tax implications of increase in 1. Capital base by corporate insurance organization, and 2. Acquisition within the industry. Question 3. In June 2004, the central bank governor introduced a major reform agenda in the banking industry. As part of the policy measure, banks in Nigeria were to increase their shareholders' fund to 25 billion naira by 31 December 2005. Since then, individual banks have taken some steps to meet this deadline. Some banks have signed memorandum of understanding as a major plan in their consummating the proposed mergers and acquisitions. Some banks have gone to the capital markets to raise additional funds by way of private placement and initial public offers (IPO). There is a proposed merger between 5 banks, some of which are quoted on the Nigeria Stock Exchange and others are unquoted. Due diligence has been embarked upon as part of the merging process. The managing director of the proposed new bank has been named. The take-off date of the new bank has been slated for 31 May 2005. In April 2005, you were appointed as a consultant with a brief to do the following. 1. Advice on the tax implications or tax issues involved before and after the merger. 2. Advice on any possible options open to them in the area of tax planning. 3. Advice on any possible tax incentive available to them. Required, advise the parties with particular reference to A. Tax issues, B. Tax implications on the merging banks and the new bank, C. Tax problems or practices. Avoid discussion of issues on personnel, accounting, etc. Solution to question 3. Merger of 5 banks, examination of tax issues involved. We refer to your brief on the above subject and like to respond as follows. A. Preamble. A merger is a form of business combination whereby 2 or more companies come together to become one enlarged surviving company. There are various tax implications on the individual banks coming together as new enlarged company. The tax implications on merging companies depend on whether the merging companies are related and in the same group, or whether they are not related or do not have common control as provided in section 25 subsection 9 of CETA 290 cap 60 LFN 2004. B. Tax issues before merger. It is important that comprehensive checks are carried out on the individual merging companies in the following areas. 1. Corporate tax. Ascertain whether the companies have filed tax returns to date and that all taxes have been fully paid. Check outstanding tax queries to determine the tax implication of any of the pending issues. Confirm that tax audit has been carried out on the companies and that taxes resulting therefrom have been paid, and obtain copies of the company's tax clearance certificate. 2. Value-added tax. Review the value-added tax compliance level of the banks to ensure that there are no outstanding liabilities, and review the audited financial statements and compute the VAT liability on the VATable non-interest incomes to compare with VAT paid over the period. 3. Capital gain tax. Ensure that capital gain tax on any assets disposed are duly paid to the relevant tax authority. 4. Withholding taxes. Check the withholding tax files of the bank to ensure that withholding tax provisions have been complied with and that all tax queries and withholding audit verification exercise have been resolved. 5. Stamp duties. Where there is increase in the share capital of any of the bank, confirm payment of adequate stamp duty, and also ensure that stamp duties are paid in all sale agreements and other deserving documents. C. Tax issues after merger. Where there is a merger of two or more banks, the tax implication will depend on whether the merging banks are related or not. 1. Where the merging banks are related with one bank having overriding control, according to section 25 subsection 9 of CETA, the following shall apply. The commencement and cessation rule shall not apply, as all the banks will be deemed to be continuing in business and assessed to tax on preceding year basis. The assets of the merging banks will be deemed to have been transferred to the new bank at tax written down values and therefore to be written off over the unexpired life of the asset. No initial allowance will be granted on the asset, and one of the companies will be required to guarantee payment of any tax liability due and payable. 2. Where the merger is of non-related banks, the following may be applied by the tax authority. All the banks will be deemed to have ceased business and cessation rules will apply. The new bank will be deemed to have commenced business and commencement rule will apply. Initial and annual allowance will be granted on the purchase cost of the asset, and the building taken over, if any, by the new bank will be valued at their purchase cost or original cost, whichever is lower. No initial allowance will be granted. D. Possible tax planning options. 1. Merger consideration payoff by shares are not liable to capital gain tax as provided in section 32A of the CGTA of 1990 Cap 42 LFN 2004. Therefore, where consideration is to be offered, it should be in shares. 2. Where the merger is between related or unrelated companies. 2. Whether the merger is between related or unrelated companies, where the assets of the bank are taken over at market value, capital allowance will be claimed on the transferred value as against the tax written down value, with the consent of the Federal Inland Revenue (FIRS). 3. Where the new bank is deemed to have commenced a new business, the taxpayer's option under section 24 subsection 3D of the CETA should be applied where it is favorable to the company. 4. Where the new company is deemed to be continuing in business, any unrelieved loss of the individual banks can be carried forward by the new bank. 5. Where there is reinvestment of proceeds of sales of an asset, rollover relief can be claimed. E. Possible tax incentive on merger. 1. Careful application of the commencement rule may result in tax savings. 2. The combined assets of the merging banks will result in higher capital allowance claimable. And 3. Unrelieved losses of the individual banks can be carried forward to be relieved from the income of the new bank if the tax authority grants the concession. Please note that the consent of the Federal Inland Revenue Service must be obtained before finalizing any merger arrangement, as specifically provided for in CETA 1990. Should you require any further explanation or clarification on the issue, Please do not hesitate to contact the undersigned, yours faithfully, for XYZ Tax Consultant, Ojo Jacob, for Managing Partner. Question 4. With respect to tax planning, you are required to comment on each of the following. A. Bonus issue and dividend. B. Employer using staff remuneration. C. An investment of 3.2 million naira in fixed deposits at a rate of 20% per annum against the same amount in a treasury bill at a rate of 18.5% per annum. D. Life assurance policy. E. A company involved in manufacturing and exportation of agricultural plants. F. Rollover relief. G. Use of leased assets. Answer to question 4. Tax planning can be described as a conscious effort on the part of the potential taxpayer to organize his or her financial transaction, that is income and expenditure, in such a way as to legitimately minimize his or her tax liability at every point in time. A. Bonus issue and dividend. An investor in a company shall prefer scrip or bonus issue to dividend payment because the latter will attract 10% withholding tax deduction on the dividend receivable. Gains made on disposal of stock and shares currently since 1998 do not suffer capital gain tax. B. Employer using staff remuneration for planning. This occurs when an employer, in a bid to minimize the tax liability of the employees, reduce the basic salaries and any other monetized benefits in favor of benefit in kind. It should, however, be noted that such benefit in kind, like employers' assets put to the employees' use, will attract 5% of the acquisition cost, if known, or 5% of the market value of the assets at the time of acquisition. Also, a company may decide to pay a lump sum to an employee and choose to regard such amount as compensation for loss of office, which attracts no tax at all. C. The investment of 3.2 million in a fixed deposit account and treasury bill. So, for fixed deposit, the principal was 3.2 at an interest rate of 20%, which gives us interest of 640,000 naira, less withholding tax of 10%, which is 64,000, gives us a net income of 576,000 naira. If the same amount is invested in treasury bill, then we have principal of 3.2 million at an interest rate of 18.5. The interest was 592,000. There is no withholding tax, so the net income is 592,000. The income savings resulting from taking the option of treasury bill is 16,000, which gives us 592,000 minus 576,000. The investor has therefore saved 16,000 in income by avoiding the withholding tax due under the fixed deposit option, having decided to invest in treasury bill. D. Life assurance allowance. An employee can minimize his tax liability by taking a life assurance policy, as actual premium payment in the preceding year is allowed for tax purposes, provided there is evidence that the policy is in his name, or in respect of a contract for a deferred annuity on his own life or the life of his spouse, and evidence of payment of the premium in form of policy certificate. Also, gains on disposal of interest under a life policy are exempted from capital gain tax. E. A company involved in manufacturing and exporting agricultural equipment instead of trading in such equipment would enjoy the following tax incentives. 1. Capital allowance are not restricted for agro-allied business or agricultural equipment manufacturing companies. Losses incurred can be carried forward indefinitely. 2. If the company in question obtained a loan for the purpose of the export business, the interest income by the bank is exempted from tax depending on moratorium and repayment period. The interest expenses are treated as allowable charges against income. Dividends received from companies in this business are exempted from tax. 3. The company can be granted pioneer status if exports account for at least 50% of the annual turnover. 4. Companies with turnover of less than 1 million will be taxed at 20% in the first 5 years. F. Rollover relief. A company may use the proceeds of sale of one asset to buy another asset of the same category and use for the same purpose as the one sold in order to escape paying capital gain tax that would have accrued on the disposal of the initial asset. Rollover relief is also granted when compensation received for loss or destruction of an asset is reinvested in replacement within 3 years. G. Use of leased assets. This is used as a means of financing purchases of fixed assets and for tax planning. There are 2 types, namely finance and operating lease. The advantages accruing to a company from applying either type of financing include under finance lease. 1. The lessee is entitled to claim capital allowance. 2. In a sale and leaseback arrangement, the lessee also claims capital allowance. 3. Instrumental payment of principal plus interest may be made by the lessee company are allowable expenses. Under operating lease, 1. The lessor will claim capital allowance. 2. Balancing charge or allowance are claimable on the event of disposal. That is the end of chapter 3. Thank you.